The numbers are simple. You make $6,000 per month. The car payment is $780. You can afford it. The dealership ran the approval, the bank signed off, your credit score qualifies. Your debt-to-income ratio sits comfortably below 40%. After taxes and fixed expenses, you still have a few $100s left over. On paper, this is a responsible purchase. Everything checks out. And that's exactly why it feels safe. The modern financial system is very good at creating psychological safety. It translates a large emotional purchase into a small, manageable monthly number, $780. Not $35,000, not $55,000, just $780. The payment fits inside your cash flow. It doesn't break your budget spreadsheet. It doesn't trigger overdraft fees. It doesn't threaten your ability to pay rent or the mortgage. So the conclusion feels rational. If the bank approved it, it must be fine. But there's one number they never show you. Not the payment, not the interest rate, not the sticker price. The total cash outflow over 84 months. 7 years. 84 withdrawals from your future. When you calculate it precisely, $780 multiplied by 84, you don't get a manageable monthly expense. You get $65,520 in payments. Add a modest down payment of $5,000. Add insurance differentials, add maintenance and registration, add interest that compounds against you instead of for you. Suddenly, the total cash outflow doesn't whisper $780, it says $97,240. That's the number that never appears on the windshield. Specificity changes gravity. $780 feels operational. $97,240 feels strategic. At first, that still seems normal. Cars cost money. Transportation isn't optional. You need reliability. You value comfort. You work hard. Until you compare it to something else. If that same $780 were invested monthly at an 8% annual return, nothing exotic, just long-term market averages. Over 7 years, you wouldn't have a depreciating asset worth perhaps $18,000 at resale. You'd have roughly $82,000. That's principal plus compounding. Now extend that another 10 years without additional contributions, letting it grow at the same 8%. That $82,000 becomes approximately $177,000. The decision was never about a car. It was about a $70,000 opportunity gap at year 7 and potentially a $160,000 gap by year 17. The affordable choice quietly converted labor into a lifestyle upgrade. The other converts labor into optionality. Banks approve loans based on debt ratios, not wealth creation. Their model checks whether you can survive the payment. It does not check whether the payment weakens your future profit margin. It doesn't measure the internal rate of return on your personal balance sheet. It doesn't evaluate how this obligation compresses your savings rate from 20% to 12%, or how that reduction compounds over decades. Approval does not equal optimization. A lender's incentive is risk-adjusted repayment. Your incentive should be long-term autonomy. Those are not the same objective function. So either car payments are harmless lifestyle expenses, just another line item in the cost of being an adult, or they're silent wealth drains disguised as normal behavior. Because once you commit to $780 per month for 84 months, you don't just buy a car, you anchor your lifestyle around that obligation. Your emergency fund target increases, your required monthly income increases, your tolerance for career risk decreases. The psychological baseline of what I need to survive rises, and higher baselines reduce freedom. We're going to reconstruct the real cost of that decision year by year, not to shame the purchase, not to moralize consumption, but to expose the difference between surviving payments and building wealth. Because the most expensive lie in modern finance isn't "you deserve it," it's "you can afford it." You traded in your car after 3 years. You upgraded. Lower mileage, better tech, better image. The dealer handled everything. You didn't have to list it privately. You didn't negotiate with strangers. You handed over the keys, signed a few forms, and drove away in something that felt like progress. They rolled over the remaining balance. The new payment? Only $120 more per month, from $780 to $900. Totally manageable. You're earning more than you were 3 years ago. Your income moved from $6,000 per month to $6,800. A $120 increase is marginal relative to that. It's less than 2% of gross income. It fits the budget. The spreadsheet still balances. Solved problem. That's how upgrading works. That's normal. But here's what didn't disappear: the unpaid balance from your last loan. After 3 years on an 84-month term, you didn't owe zero. You might have paid roughly $28,000 in payments, but because early amortization is interest-heavy and cars depreciate quickly, your remaining balance could still be $32,000. Meanwhile, the vehicle's market value might be $26,000. There's a $6,000 gap. Negative equity. It didn't vanish. It moved. That $6,000 was added to the new loan on the $45,000 upgrade. Now you're not financing $45,000. You're financing $51,000 plus taxes and fees, maybe $54,000 total. Debt didn't reset. It compounded. The time horizon restarted at 72 or 84 months. The depreciation clock restarted. The interest clock restarted. And psychologically, it feels clean because the old car is gone. But financially, the old obligation is still attached, just hidden inside a larger number. After 2 upgrades, something strange happens. You've been making payments for 6 years, 72 consecutive months of outflow. But you've never owned a car outright. You financed depreciation twice. Year 1 to 3, depreciation outpaced principal reduction. Year 4 to 6, same pattern, larger base. If the first loan averaged $780 and the second averaged $900, you've paid roughly $60,000 across 6 years, and yet your current vehicle might still have a $38,000 balance with a resale value of $34,000. Equity never catches up because the system is designed around perpetual turnover. Long loan terms, 72, 84 months, combined with rapid depreciation create a structural lag. You're always slightly behind the asset's true value. Progress feels real. The dashboard is digital. The interior smells new. The neighbors notice. Ownership never arrives. From a balance sheet perspective, your transportation line item behaves like a subscription model. Continuous payment, continuous upgrade, continuous reset. You think you're upgrading your lifestyle, but your fixed expenses are upgrading faster than your income. Your transportation cost moved from $780 to $900. Insurance increased by $40 per month because the vehicle is newer and more expensive to repair. Registration increased. Maintenance on premium models costs more per visit. Your total transportation outflow might now be $1,100 per month. If you're earning $6,800 monthly and saving 15%, that's $1,020 toward investing. One category, transportation, now exceeds your monthly capital deployment. Your investing rate shrinks not because you lack discipline, but because fixed costs absorbed the margin. And margin is where freedom lives. When fixed expenses rise, optionality falls. It becomes harder to take a lower-paying role but higher upside, harder to start a business, harder to tolerate a volatile year in commissions, harder to weather layoffs without stress. The car looks better. Your balance sheet doesn't. So either upgrading cars every 3 years is a normal reward for hard work, a rational use of rising income and a stable career trajectory, or it's a financial treadmill designed to keep you running in place. Because once negative equity becomes normal, the cycle can continue indefinitely. Trade in at year 3, roll over $4,000, upgrade, repeat. In a 2-car household, double the exposure. 2 $900 payments become $1,800. Add insurance, fuel, maintenance, you're easily at $2,300 per month. That's $27,600 per year directed towards depreciating assets. Invested at 8% annually for 15 years, that same $27,600 per year compounds to over $750,000. This isn't about never upgrading. It's about understanding the machine, the negative equity cycle, why trade-ins rarely reset debt, how multi-car households amplify the trap, how high fixed payments quietly reduce freedom by raising your psychological baseline of required income. We're going to break down the mechanism step by step, because the most dangerous financial systems aren't the ones that look reckless, they're the ones that look normal.